Today we're diving deep into a mysterious player in the investment world, the AGGH ETF. It promises safety and steady returns, but there's more to the story than meets the eye. We'll be cracking open the hood of AGGH to see how it works, its hidden fees, and whether it can truly protect your portfolio from a downturn. So, is AGGH a game changer or just a flashy facade? Stick around to find out. What is Simplify Aggregate Bond ETF AGGH? The Simplify Aggregate Bond ETF, ticker symbol AGGH, is an exchange-traded fund, ETF, designed to provide investors with exposure to investment-grade bonds while attempting to mitigate credit risk. Here's a breakdown of its key aspects. Investment objective. Maximize total return. AGGH aims to deliver strong overall returns by investing primarily in investment-grade corporate bonds. These bonds are generally considered safer than high-yield, junk, bonds because they are issued by companies with a higher creditworthiness. Mitigate credit risk. While investment-grade bonds are considered less risky, there's still a chance the issuer could default on their debt. AGGH employs various strategies to hedge against this risk, aiming to lessen the impact on the fund's value if defaults occur. Investment strategy. Core bond holding. The majority of AGGH's holdings are investment-grade bonds. This provides the fund with a foundation of stable income and potential for capital appreciation as bond prices rise. Credit hedges. AGGH incorporates various tools to hedge against credit risk. CDX calls. These are options contracts that give AGGH the right to buy credit default indexes, CDX. When bond defaults increase, the value of CDX rises, and AGGH can potentially profit from these contracts, offsetting losses in the underlying bond holdings. Quality junk factor-based hedges. This involves using derivatives or other instruments that benefit when the spread between investment-grade and high-yield bond yields widens. In simpler terms, AGGH might profit when the risk premium for holding riskier bonds increases relative to safer ones. Equity puts. In some situations, AGGH might utilize put options on equities. These options give the fund the right to sell stocks at a certain price in the future. If the stock market experiences a downturn, the value of these puts would increase, potentially offsetting losses in the bond portfolio. Key considerations. Expense ratio. AGGH charges an expense ratio, a fee that covers the costs of managing the ETF. It's important to compare this ratio to other similar bond ETFs to assess the relative cost efficiency. Portfolio duration. Duration measures a bond's sensitivity to interest rate changes. A higher duration means the price of the bond will fluctuate more significantly with interest rate movements. Understanding AGGH's duration helps assess its potential volatility. Liquidity risk. While ETFs generally offer easy buying and selling, there's a chance that some underlying bond holdings within AGGH might be less liquid, meaning it could take longer to buy or sell them at a fair price. Alternatives. Investors should compare AGGH to other bond ETFs offering similar credit risk mitigation strategies or explore purely passive investment-grade bond exposure options. Overall, AGGH can be a suitable option for investors seeking a balance between income. Investment-grade bonds typically offer regular interest payments. Growth. Bond prices can appreciate over time, especially when interest rates fall. Risk management. The credit hedge strategies aim to lessen the impact of potential defaults on the overall fund performance. When was Simplify Aggregate Bond ETF AGGH launched, and what was the rationale behind its creation? The Simplify Aggregate Bond ETF AGGH was launched on February 14, 2022. The rationale behind its creation likely stemmed from a desire to address two key investor needs in the fixed income market. 1. Seeking higher returns in a low interest rate environment. Following the 2008 financial crisis, central banks around the world implemented historically low interest rates to stimulate economic growth. This made it challenging for investors to find traditional bond funds that offered attractive yields. AGGH's creators might have seen an opportunity to address this by employing an active management strategy. By incorporating credit hedges alongside core investment-grade bond holdings, AGGH aimed to potentially generate higher returns than a typical passively managed bond ETF tracking a broad investment-grade bond index. 2. Mitigating credit risk while maintaining bond exposure. While investment-grade bonds are generally considered safer than high-yield bonds, there's still a risk of issuer defaults, which can negatively impact the value of a bond fund. AGGH aimed to provide a solution for investors who wanted exposure to the potential benefits of investment-grade bonds, income and capital appreciation, but also desired some level of protection against credit risk. By incorporating credit hedge strategies like CDX calls and quality junk factor-based hedges, AGGH sought to lessen the impact of defaults on the overall fund performance. Here are some additional points to consider. The launch timing in February 2 might have coincided with investor concerns about rising inflation, which can put downward pressure on bond prices. AGGH's credit hedge strategies could have been viewed as a way to potentially mitigate some of these risks. The specific details behind AGGH's creation are likely not publicly available. However, by understanding the broader market environment and investor needs at the time, we can make educated guesses about the rationale for launching this ETF. Does Simplify have a history of managing similar fixed income ETFs? Or is AGGH a new approach for them? Simplify Asset Management does not have a long history of managing similar fixed income ETFs like AGGH. While they offer a variety of ETFs across different asset classes, their fixed income offerings are relatively new as of June 2024. Here's a breakdown. Focus on innovation. Simplify positions itself as a company building innovative portfolio building blocks. Their core offerings include thematic equity ETFs and strategies focused on capturing specific market factors. Limited fixed income experience. Prior to AGGH, launched in February 2022, Simplify's fixed income offerings were limited. They do have other fixed income ETFs like Simplify MBS ETF, MTBA launched in December 2021. MTBA focuses on mortgage-backed securities, offering a different risk-return profile than a traditional bond ETF. Simplify Stable Income ETF, BUCK, launched in June 2022. BUCK aims to provide consistent income with a focus on lower volatility fixed income securities. AGGH as a new approach. While Simplify has some experience with fixed income products, AGGH represents a more unique approach. It combines investment-grade bond exposure with active credit risk management strategies, which wasn't present in their earlier offerings. Here's what this might mean for investors. Limited track record. Since AGGH is a relatively new ETF, there's a shorter track record to analyze its performance compared to similar funds or its stated objectives. Focus on innovation. However, AGGH's launch reflects Simplify's focus on creating innovative products. This could be appealing to investors seeking a different approach to fixed income investing. Importance of further research. Given the limited track record, it's crucial for investors to conduct thorough research on AGGH's investment strategy, risk profile, and fees before investing. Comparing it to other bond ETFs with similar objectives and a longer track record can be a valuable exercise. How has AGGH performed compared to its benchmark or similar ETFs since its inception? Analyzing AGGH's performance since its launch in February 2022 requires looking at a few key factors. 1. Benchmark comparison. Identify the benchmark. Unfortunately, there isn't a single, universally agreed upon benchmark for AGGH. This is because its strategy combines elements of both passively managed investment-grade bond ETFs and actively managed bond funds with credit protection strategies. Potential benchmarks. Depending on the specific weightings within AGGH, some potential benchmarks for comparison could be Broad Investment Grade Bond Index. This could be an index like the Bloomberg Barclays U.S. Aggregate Bond Index, which tracks the performance of a wide range of investment-grade U.S. corporate bonds. Actively managed bond funds with credit protection. These could be funds that employ similar strategies to AGGH, utilizing credit derivatives or other techniques to mitigate credit risk. 2. Performance metrics. Total return. This metric reflects the overall change in the value of an investment, including both price appreciation and reinvested dividends or interest payments. It's important to compare AGGH's total return to its chosen benchmark over various timeframes, for example, since inception, past year, and so on. Risk-adjusted returns. Metrics like Sharpe ratio or Sortino ratio can help assess how much return AGGH has generated compared to the level of risk it has taken on. A higher ratio indicates better risk-adjusted performance. 3. Resources for performance analysis. Financial websites. Websites like Morningstar, Bloomberg, or Yahoo Finance can provide historical performance data for AGGH and its potential benchmarks. They might also offer tools to compare risk-adjusted returns. Simplify asset management. While not a substitute for independent research, Simplify might provide some performance data and comparisons on their website or through investor relations channels. Elaborate on AGGH's strategy of maximizing total return by investing primarily in investment-grade (IG) bonds while mitigating credit risk. How does it achieve this balance? AGGH's strategy of maximizing total return by investing primarily in investment-grade bonds while mitigating credit risk involves a two-pronged approach. 1. Core investment-grade bond exposure. Foundation for income and growth. The majority of AGGH's holdings are investment-grade corporate bonds. These bonds are generally considered safer than high-yield, junk bonds because they are issued by companies with a higher creditworthiness. This translates to a lower risk of default, but also typically comes with lower potential returns compared to riskier bonds. Stable income stream. Investment-grade bonds typically offer regular interest payments, providing investors with a predictable income stream. Potential for capital appreciation. Bond prices generally move inversely to interest rates. When interest rates fall, existing bonds become more valuable, and AGGH can potentially benefit from this price appreciation. 2. Mitigating credit risk with derivatives. Hedging against defaults. While investment-grade bonds are considered safer, there's still a chance the issuer could default on their debt. AGGH utilizes various credit derivatives to hedge against this risk. These derivatives aim to offset potential losses in the underlying bond portfolio if defaults occur. Here are some of the tools AGGH might use. CDX calls. These are options contracts that give AGGH the right, but not the obligation, to buy credit default indexes, CDX, at a certain price in the future. When defaults increase, the value of CDX rises, and AGGH can potentially profit from these contracts. This profit can help offset losses in the bond portfolio if defaults occur within the companies tracked by the CDX. Quality junk factor-based hedges. This involves using derivatives or other instruments that benefit when the spread between investment-grade and high-yield bond yields widens. In simpler terms, imagine AGGH making a bet that the risk premium for holding riskier bonds, high yield, will increase relative to safer ones, investment grade. If this spread widens, the value of these hedges would increase, potentially offsetting any losses in the core investment grade bond holdings. Equity puts. In some situations, AGGH might utilize put options on equities. These options give the fund the right to sell stocks at a certain price in the future. If the stock market experiences a downturn, the value of these puts would increase, potentially offsetting losses in the bond portfolio. Finding the balance. Active management. The key to AGGH's strategy lies in actively managing the allocation between core investment-grade bonds and credit hedges. This involves continuously evaluating market conditions, credit risks, and the potential returns of different strategies. Maximizing total return. By combining the income stream and potential capital appreciation from investment-grade bonds with the risk mitigation benefits of credit hedges, AGGH aims to achieve a balance between generating attractive total returns and protecting against potential losses from defaults. How does AGGH determine the allocation between investment-grade bonds and credit hedges? The specific details of how AGGH determines the allocation between investment-grade bonds and credit hedges are likely not publicly available. However, we can analyze the factors that might influence their decision-making process. 1. Market conditions. Interest rates. Rising interest rates generally put downward pressure on bond prices. AGGH might increase its allocation to credit hedges during periods of rising rates to protect the value of its core investment-grade bond holdings. Conversely, during periods of falling rates, they might decrease the hedge allocation to capture the potential capital appreciation of bonds. Credit spreads. The spread between investment-grade and high-yield bond yields reflects the additional risk premium investors demand for holding riskier debt. AGGH might increase its allocation to quality junk factor-based hedges when this spread widens, aiming to profit from this widening spread and potentially offset losses in the core holdings. Volatility. During periods of increased market volatility, AGGH might increase its hedge allocation to mitigate potential losses across the portfolio. 2. Credit risk analysis. Issuer creditworthiness. AGGH likely analyzes the creditworthiness of individual bond issuers within its portfolio. This analysis might influence the overall credit hedge allocation. For example, if the fund holds a higher concentration of bonds from issuers with a weakening credit outlook, they might increase the hedge allocation to mitigate potential defaults. Industry exposure. The creditworthiness of companies within specific industries can be cyclical. AGGH might adjust its hedge allocation based on the overall industry exposure of its bond holdings. For instance, if the fund has a significant allocation to bonds issued by companies in a struggling industry, they might increase hedges to protect against potential industry-wide defaults. 3. Cost-benefit analysis. Hedge costs. As mentioned earlier, using credit derivatives like CDX calls involves costs. AGGH will likely consider the cost of these hedges and weigh it against the potential benefits, protection against defaults, when making allocation decisions. Expected returns. AGGH might also factor in the expected returns from different asset classes. If the potential returns from investment-grade bonds become more attractive relative to the costs of credit hedges, they might decrease the hedge allocation and vice versa. 4. Investment objective. Overall risk tolerance. Ultimately, AGGH's target allocation between investment-grade bonds and credit hedges might be guided by its overall investment objective. The fund might prioritize higher potential returns with a corresponding increase in risk, lower hedge allocation, or prioritize capital preservation with a higher hedge allocation, even if it comes at the expense of some potential returns. How does AGGH's portfolio duration, currently 8.40, compare to other bond ETFs, and how will it impact the fund's sensitivity to interest rate changes? AGGH's portfolio duration, compared to other bond ETFs. Understanding duration. Duration is a measure of a bond or bond portfolio's sensitivity to changes in interest rates. It's expressed in years and reflects the average time it takes to receive all the expected cash flows, both principal and interest payments, from the underlying bonds. AGGH's duration, 8.40. A duration of 8.40 suggests AGGH is moderately sensitive to interest rate changes. Compared to other bond ETFs, this duration could fall into different categories depending on the specific ETF universe. Shorter duration bond ETFs, typically less than 5 years, these aim to minimize interest rate risk and might be suitable for investors seeking more stability in their bond holdings. Examples include ETFs focused on short-term corporate bonds or government treasuries. Intermediate duration bond ETFs, typically between 5 and 10 years, this is a broad category, and AGGH's duration of 8.40 falls within this range. These ETFs offer a balance between potential returns and interest rate risk. Longer duration bond ETFs, typically over 10 years, these offer the potential for higher returns but also expose investors to greater interest rate risk. Examples include ETFs focused on long-term government bonds or high-yield corporate bonds. Impact on interest rate sensitivity. General rule: as a rule of thumb, for every 1% increase in interest rates, a bond's price will decrease by approximately its duration in years. Conversely, for every 1% decrease in interest rates, a bond's price will increase by approximately its duration. Example for AGGH. With a duration of 8.40, if interest rates rise by 1%, the price of the bonds held by AGGH could decrease by around 8.4%. This highlights the potential volatility of the fund if interest rates experience a significant upward movement. Additional considerations. The actual impact of interest rate changes on AGGH's price can be more nuanced than the general rule suggests. Factors like the specific maturity structure and call provisions of the underlying bonds can also influence price movements. AGGH's credit hedge strategies might partially mitigate the impact of rising interest rates. For example, if the value of CDX calls increases when defaults rise due to higher rates, this could offset some of the losses in the core bond holdings. However, the effectiveness of these hedges depends on their design and the specific market scenario. For investors, understanding AGGH's duration relative to other bond ETFs helps assess its potential volatility in different interest rate environments. Investors seeking to minimize interest rate risk might consider bond ETFs with shorter durations. Those comfortable with more volatility for potentially higher returns could find AGGH's intermediate duration appealing. What are the potential risks associated with using credit derivatives like CDX calls within the ETF? While credit derivatives like CDX calls offer potential benefits for mitigating credit risk within AGGH, they also come with inherent risks that investors should be aware of. 1. Counterparty risk. CDX calls are contracts between AGGH and another financial institution. There's a risk that the counterparty could default on their obligations under the contract, leaving AGGH potentially exposed if defaults occur within the CDX index. To mitigate this risk, AGGH likely deals with reputable counterparties with strong creditworthiness. However, counterparty risk can never be entirely eliminated. 2. Basis risk. CDX calls track a broad index of investment-grade corporate bonds. There's a chance that the specific bonds held within AGGH's portfolio might not perfectly correlate with the performance of the CDX index. This mismatch, known as basis risk, could limit the effectiveness of the hedges in offsetting losses from defaults within the actual bond holdings. 3. Hedging costs. Utilizing CDX calls involves costs, premiums, paid to the counterparty. These costs eat into the overall returns of AGGH. The potential benefits of the hedges, protection against defaults, need to outweigh the costs for the strategy to be effective. 4. Imperfect hedges. Even if defaults occur within the CDX index, the profit from CDX calls might not perfectly offset the losses in AGGH's core bond portfolio. This can happen due to various factors like limited scope of hedges. CDX calls might not provide perfect protection against defaults from all issuers within AGGH's portfolio. Market volatility. During periods of high market stress, the value of CDX calls might not rise as much as expected, limiting their effectiveness as hedges. 5. Complexity and transparency. Understanding the pricing and mechanics of CDX calls can be complex. Investors are relying on the expertise of the AGGH management team to effectively utilize these derivatives. The specific details of the CDX call contracts used by AGGH might not be publicly available, making it challenging for investors to fully assess the associated risks. Here's what this means for investors. The potential benefits of CDX calls, protection against defaults, need to be weighed against the associated risks. Investors should carefully consider their own risk tolerance before investing in AGGH, especially if they are uncomfortable with the use of complex derivatives. How does AGGH manage liquidity risk, considering some bond holdings might be less liquid than others? AGGH faces liquidity risk due to the potential mismatch between the liquidity of its underlying bond holdings and the ease with which investors can buy or sell shares of the ETF itself. Here's a breakdown of how AGGH might manage this risk. Understanding liquidity risk. Liquidity risk refers to the difficulty of buying or selling an asset quickly and at a fair price. In the context of AGGH, some of the individual investment-grade bonds held within the fund might be less liquid than others. This means it could take longer to buy or sell these specific bonds on the secondary market, potentially at a discount, if AGGH needs to adjust its portfolio. Potential strategies for AGGH. Focus on relatively liquid bonds. AGGH might prioritize investment-grade bonds with a higher trading volume and better secondary market liquidity. This allows the fund to enter and exit positions more easily when necessary. Portfolio diversification. Holding a diversified basket of investment-grade bonds across different issuers and maturities can help mitigate liquidity risk. While some individual holdings might be less liquid, the overall portfolio becomes more manageable. Use of cash equivalents. AGGH could allocate a portion of its assets to highly liquid cash equivalents like treasury bills. This readily available cash provides a buffer for managing redemptions or portfolio adjustments, even if selling some less liquid bond holdings takes time. ETF structure and redemptions. Unlike a traditional mutual fund, ETFs don't directly redeem shares from individual investors. Authorized participants, typically large institutions, create or redeem large blocks of ETF shares directly with the fund manager. This creation/redemption process usually involves the underlying assets, bonds in AGGH's case, being exchanged. By dealing in larger creation/redemption units, AGGH can potentially manage liquidity risks associated with individual bond holdings more efficiently. Factors affecting liquidity risk. Market conditions. During periods of market stress or economic turmoil, overall liquidity can deteriorate. Even typically liquid assets might become more difficult to buy or sell. This can magnify liquidity risk for AGGH. Bond maturities. Bonds closer to their maturity dates are generally more liquid than those with longer maturities remaining. AGGH's portfolio maturity structure can influence its overall liquidity profile. For investors. While AGGH employs strategies to manage liquidity risk, it's important to understand that the fund itself might not be as perfectly liquid as some other asset classes like publicly traded stocks. There's a chance that buying or selling shares of AGGH at a specific price might be challenging, especially during volatile market conditions. Investors with shorter investment horizons or a need for immediate access to their capital might want to consider this liquidity risk factor before investing in AGGH. What is the current expense ratio of AGGH, and how does it compare to other similar bond ETFs? AGGH's expense ratio and comparison. Current expense ratio. The current expense ratio of AGGH is 0.5%. This means that for every $10,000 invested in the ETF annually, investors would incur fees of $50. Comparison to similar ETFs. Here's a comparison of AGGH's expense ratio to other bond ETFs with similar investment objectives. Passively managed investment-grade bond ETFs. These ETFs typically track a broad investment-grade bond index and have lower expense ratios. Examples: iShares Core US Aggregate Bond ETF, AGG expense ratio 0.09%. Schwab US Aggregate Bond ETF, SCHX expense ratio 0.04%. Actively managed bond ETFs with credit protection strategies. These ETFs might employ similar strategies to AGGH, but with potentially different expense ratios. Finding a perfect comparison can be challenging due to variations in specific strategies. Here are some examples. PIMCO Total Return ETF, TRXT expense ratio 0.75%. Nuveen Enhanced Fixed Income Fund, NEFIX expense ratio 0.82%. Important considerations. Lower expense ratio versus active management. Passively managed bond ETFs generally have lower expense ratios compared to actively managed ones like AGGH. This is because passively managed funds simply track an index and require less ongoing management. Potential for higher returns. Actively managed funds like AGGH, with their credit hedge strategies, aim to potentially generate higher returns than passively managed ones. However, there's no guarantee that this will always be the case. Weighing fees versus potential benefits. Investors need to weigh the lower expense ratios of passively managed bond ETFs against the potential for higher returns that AGGH, with its active management strategies, might offer. Does AGGH have any specific maturity targets for its underlying bond holdings? AGGH likely doesn't have a single, specific maturity target for its underlying bond holdings. Here's why. Focus on investment grade. The core component of AGGH's portfolio is investment-grade corporate bonds. These bonds come with various maturities, ranging from a few years to decades. Balancing income and growth. AGGH likely seeks a balance between generating income from the bond holdings and achieving potential capital appreciation. This can be achieved by holding a mix of bonds with different maturities. Dynamic portfolio management. The specific maturity profile of AGGH's holdings might change over time based on market conditions, interest rate expectations, and the availability of attractive investment opportunities. Here's a breakdown of some factors that might influence the maturity structure of AGGH's portfolio. Interest rates. If interest rates are expected to rise, AGGH might favor shorter duration bonds to minimize potential losses in price due to rising rates. Conversely, during periods of falling rates, the fund might increase its allocation to longer duration bonds to capture the potential for capital appreciation. Credit spreads. The spread between investment-grade and high-yield bond yields can also influence the maturity composition. If the spread widens, AGGH might hold more short-term bonds to benefit from the wider risk premium for riskier debt. Yield curve. The slope of the yield curve, relationship between bond maturities and yields, can also be a factor. A steeper curve might incentivize holding longer duration bonds for higher potential returns, while a flat curve might favor shorter duration bonds to manage interest rate risk. For investors, while AGGH might not have a single maturity target, the overall duration of the fund, currently 8.40, provides some insight into its maturity profile. A higher duration indicates a greater sensitivity to interest rate changes. Investors seeking exposure to specific maturity segments of the bond market might be better suited with bond ETFs that target those specific maturities, for example, short-term corporate bond ETFs or long-term government bond ETFs. How does AGGH compare to traditional actively managed bond funds in terms of fees, transparency, and risk management? Here's a comparison of AGGH, an actively managed ETF, with traditional actively managed bond funds across fees, transparency, and risk management. Fees. AGGH, expense ratio of 0.5%. This is generally lower than the expense ratios of traditional actively managed bond funds, which can range from 0.75% to 1.50% or even higher. Transparency. AGGH, lower transparency. AGGH doesn't disclose its specific holdings or their weightings within the portfolio on a regular basis. This makes it difficult for investors to conduct thorough due diligence on the underlying bonds. Traditional funds, generally higher transparency. Traditional actively managed bond funds typically disclose their holdings quarterly or even monthly. This allows investors to see the specific companies and sectors within the portfolio and assess the credit quality of the holdings. Risk management. AGGH employs credit derivatives, CDX calls, to hedge against potential defaults within the investment-grade bond portfolio. This can help mitigate credit risk, but comes with its own complexities and limitations. Traditional funds, risk management strategies can vary depending on the specific fund. Some funds might utilize derivatives, while others might rely on active portfolio selection and credit analysis to manage risk. Additional considerations. Liquidity. AGGH, like all ETFs, trades on an exchange and offers daily liquidity. Traditional actively managed bond funds might have redemption fees or take a few days to process redemption requests. Tax efficiency. Both AGGH and traditional actively managed bond funds can generate taxable capital gains distributions. However, ETFs might offer some tax efficiency advantages due to their in-kind creation and redemption process. Are there other bond ETFs that offer similar credit risk mitigation strategies, and how do they differ from AGGH? Yes, there are other bond ETFs that utilize credit risk mitigation strategies, but the specific approaches and target audiences can differ from AGGH. Here's a breakdown. Types of credit risk mitigation strategies in bond ETFs. Focus on short maturity bonds. These ETFs primarily hold bonds with shorter maturities, typically less than 5 years, to minimize interest rate risk and potential defaults. Examples include short-term corporate bond ETFs or short-term treasury ETFs. Active management with credit selection. These ETFs employ active management to select investment-grade bonds with strong creditworthiness and potentially lower default risk. They might not use complex derivatives like AGGH's CDX calls. Examples include actively managed core bond ETFs with a focus on credit quality. Municipal bond ETFs. These ETFs invest in municipal bonds issued by state and local governments. These bonds generally offer tax-exempt interest income and are considered to have lower default risk than corporate bonds. Credit quality screens. Some bond ETFs might apply credit quality screens to their holdings, focusing on a specific investment-grade rating range, for example, BBB rated or higher, to manage credit risk within the portfolio. Important considerations. The choice between AGGH and alternative bond ETFs depends on your investment goals and risk tolerance. If minimizing interest rate risk is a priority, short-term bond ETFs might be a better option. If you prefer a more transparent approach with a focus on credit selection by the fund manager, actively managed core bond ETFs could be suitable. Tax-exempt income seekers might prioritize municipal bond ETFs. Investors seeking a balance between credit quality and yield within a transparent structure could consider credit quality screened bond ETFs. For investors seeking a purely passive investment-grade bond exposure, what alternative ETFs could be considered? For investors seeking purely passive investment-grade bond exposure, several exchange-traded funds, ETFs, offer a good alternative to AGGH, which has an actively managed component with credit derivatives. Here are some key considerations and potential options. Focus on passive investment-grade bond exposure. These ETFs track a broad index of investment-grade corporate bonds, offering diversified exposure to the asset class. They passively replicate the holdings of the index, resulting in lower expense ratios compared to actively managed funds like AGGH. The performance of these ETFs is directly tied to the underlying index, and they don't attempt to outperform it through active management strategies. Popular passive investment-grade bond ETFs. Here are some of the most popular choices for investors seeking purely passive investment-grade bond exposure. iShares Core U.S. Aggregate Bond ETF, AGG, tracks the Bloomberg Barclays U.S. Aggregate Bond Index, a broad market benchmark for investment-grade U.S. corporate bonds, treasuries, and mortgage-backed securities. It has a very low expense ratio, around 0.09%. Schwab U.S. Aggregate Bond ETF, SCHX, tracks the FTSE U.S. Broad Treasury Bond Index, offering exposure to a wide range of U.S. government bonds with maturities exceeding 1 year. It boasts an exceptionally low expense ratio, around 0.04%. Vanguard Total Bond Market ETF, BND, tracks the Bloomberg Barclays U.S. Universal Bond Index, providing diversified exposure to the entire U.S. bond market, including investment-grade corporate bonds, treasuries, and mortgage-backed securities. Its expense ratio is also low, around 0.04%. Important considerations when choosing a passive investment-grade bond ETF. Underlying index. Research the specific index each ETF tracks. Some focus solely on investment-grade corporate bonds, while others might include treasuries or mortgage-backed securities. Expense ratio. Compare expense ratios across different ETFs. Lower expense ratios translate to higher returns for you in the long run. Maturity exposure. Consider the average maturity of the bonds within the ETF's holdings. This will influence the ETF's sensitivity to interest rate changes. Liquidity. Most large, established passive bond ETFs are highly liquid, meaning you can easily buy and sell shares on an exchange. How would AGGH fit within a broader portfolio allocation strategy, and what are some potential diversifying assets to consider alongside it? Potential role of AGGH. AGGH, with its focus on investment-grade corporate bonds and credit hedge strategies, can potentially play a role in a portfolio allocation strategy aimed at achieving the following goals. Generating income. AGGH seeks to provide regular income from the interest payments on the underlying bonds. Balancing risk and return. Compared to stocks, investment-grade bonds offer lower potential returns, but also generally lower volatility. AGGH's credit hedge strategies might further mitigate some downside risk. Partial protection against inflation. While not a perfect hedge against inflation, bonds can offer some protection compared to assets like cash. Portfolio allocation considerations. The suitability of AGGH within your portfolio depends on several factors, including Investment horizon. If you have a shorter investment horizon, less than 5 years, AGGH's exposure to interest rate risk might not be ideal. Consider shorter duration bond options. Risk tolerance. AGGH has some inherent risks like credit risk, potential defaults, and interest rate risk. Investors with a lower risk tolerance might want a smaller allocation to AGGH or consider other asset classes. Overall portfolio goals. AGGH is just one piece of the puzzle. You'll need to consider your overall asset allocation strategy to achieve your desired risk-return profile. Diversifying assets to consider alongside AGGH. To achieve a well-diversified portfolio, consider these potential asset classes alongside AGGH. Stocks offer the potential for higher long-term returns, but also come with greater volatility. Consider broad market index funds or sector-specific ETFs, depending on your risk tolerance and investment goals. Small-cap stocks can offer higher potential returns than large-cap stocks, but also come with greater risk. Allocate a smaller portion compared to large-cap exposure if interested. International stocks provide exposure to developed and emerging markets, potentially improving diversification and offering potential for higher returns. Consider developed market ETFs or emerging market ETFs. Real estate investment trusts, REITs, can provide income and potential for capital appreciation through rental income and property value increases. Consider REIT ETFs focused on different property sectors, residential, commercial, based on your preference. Commodities offer diversification from traditional stocks and bonds but can be volatile. Consider broad commodity ETFs or specific commodity ETFs like gold or oil, depending on your investment thesis. Cash equivalents provide liquidity and safety for short-term needs. Consider high-yield savings accounts or short-term bond ETFs. Alright, folks, that's all the time we have for AGGH today. Remember, AGGH can be a piece of a well-diversified portfolio, but it's not a magic bullet. Consider your investment goals, risk tolerance, and the bigger picture before making a decision. For those who want a more passive approach, we explored some great alternative ETFs throughout the video. No matter what path you choose, do your research and invest wisely. Thanks for watching. Don't forget to like and subscribe for more investment breakdowns.